Okay, let's dive straight in. On May 7th, 2025, a small tech company you might not have heard of, Asset Entities ticker ASST, pulled off a truly head-turning move.
Yeah, this was pretty surprising.
Forget a simple merger. This was a complete corporate reinvention, all hinging on one very specific and, let's be honest, potentially explosive asset, Bitcoin.
Hmm.
The new identity. Strive's public Bitcoin treasury company. It's a bold bet, and we're about to unpack why.
And what's fascinating here is this growing trend, still maybe in its early stages, of companies actually holding Bitcoin as a core part of their financial reserves.
Right, like MicroStrategy.
Exactly. MicroStrategy, now just strategy. They were really the pioneers here,
Yeah.
shifting away from, just holding cash to including digital assets on their balance sheet. It's a significant departure from the norm, and it really begs the question, what are the real implications?
Exactly. And that's the mission for this deep dive. We're going to dissect this radical shift by the newly formed Strive AST from a value investing lens.
So looking at the fundamentals,
Yep. We're looking at the nuts and bolts of the business, the people calling the shots, the financial implications, and how the markets reacted to this unprecedented move. Consider this your fast track to understanding the core of what's happening and why it could be relevant to you.
and we've got some good source material to work from.
We do. We've sifted through an AST deep value analysis from that very day, May 7th, 2025, along with related news articles to extract the crucial insights. So first things first, let's wrap our heads around the core of the operation. What exactly is a public Bitcoin treasury company?
Well, the fundamental change here is a pivot away from AST's past in, what was it, social media marketing?
Something like that, yeah.
The new central business model is being a public Bitcoin treasury company. Essentially, their main focus is now accumulating Bitcoin as a primary asset on their corporate balance sheet
Okay.
and their stated aim to maximize Bitcoin exposure per share over the long run. Traditional ways of making money, like revenue from services, they become secondary to this core goal of Bitcoin accumulation.
Okay, so they're not selling a product or service in the usual sense. How then do they plan to actually create value for shareholders?
Their strategy for generating value rests on three key pillars. The most straightforward is, well, the direct appreciation of Bitcoin's price. If Bitcoin goes up, the value of their holdings increases. Simple enough.
Does sense?
But they're also aiming to actively manage their Bitcoin treasury to outperform Bitcoin itself.
Oh, interesting. So not just hold it.
Right. They're setting Bitcoin's returns as their benchmark, implying they intend to use active strategies to generate even better results than simply holding. And the third element involves potentially using sophisticated financial maneuvers related to Bitcoin, leveraging their team's experience in fixed income and derivatives.
Interesting. So it's not just a passive holding strategy. What specific products or methods are they putting in place to actually acquire more Bitcoin? This is where it gets really interesting, I think.
Yeah, this is where things get truly novel. They've announced several unique approaches. The first is what they're calling a first of its kind, Section 351 tax-free exchange.
Section 351, explain that a bit.
So this would allow Bitcoin holders to contribute their Bitcoin directly into the company in exchange for shares of AST stock, potentially up to a total value of $1 billion.
Wow, $1 billion.
Yeah. The idea is to provide a tax-advantaged way for Bitcoin holders to convert their private crypto holdings into publicly traded stock. That's the pitch, anyway.
Okay, what else?
Second, they have an M&A strategy, but with a twist. They're looking to acquire overcapitalized public companies trading below their net cash value, with the aim of essentially buying that cash at a discount and then using it to purchase Bitcoin.
Acquire companies just for their cash to buy Bitcoin. That's
It is. Third, they intend to employ leverage, basically, borrowing funds to increase their Bitcoin holdings. And they'll use hedging strategies, drawing on their expertise in fixed income and derivatives to manage the inherent risks that come with leverage and Bitcoin's volatility.
right. That leverage part sounds risky.
It definitely adds risk. And finally, they plan to actively advocate for other public companies, particularly those within Strive Asset Management's existing funds, to adopt Bitcoin treasury strategies themselves.
So push the idea more broadly.
Exactly. Kind of create a wider movement, which could indirectly benefit their own holdings too.
That's a pretty unconventional and aggressive approach. What's their position in the market and what's the scale we're talking about here?
They're positioning themselves as the first publicly traded asset management Bitcoin treasury company. It gives them a unique, though maybe very narrowly defined, position in the market.
Okay.
Now, scale. While Strive Asset Management, the parent or controlling entity, Has around, what, $2 billion in assets under management across its various funds.
Hmm.
AST, the company they merged with to go public, was quite small beforehand. Its market capitalization was only around $8.8 million.
Tiny, relatively speaking.
Very small. So they're using this relatively small public platform as the foundation to build what they hope will become a significant Bitcoin treasury.
So who stands to benefit from this new structure? What's the core value proposition for different stakeholders?
Well, for the existing common shareholders of AST, the ones who were there before the merger, the primary potential benefit lies in the amplified exposure to Bitcoin's price movements on a per-share basis. That's the theory.
If Bitcoin goes up, their small piece gets magnified.
Potentially. For Bitcoin holders who might participate in that Section 351 exchange, it offers a potentially tax-efficient route to gain exposure to the public equity markets with their Bitcoin.
A way to turn crypto into stock without a big tax hit immediately.
That's the idea. And for the broader market, the pitch is that Strive offers an actively managed Bitcoin treasury, aiming to achieve better returns than simply holding Bitcoin directly or investing in, say, a passive Bitcoin ETF.
Okay, let's broaden our view then. What's the bigger picture of this trend of corporate Bitcoin treasuries and the overall digital asset management landscape?
Well, the trend of companies holding Bitcoin as a treasury asset is certainly gaining traction. We've seen pioneers like Strategy demonstrate the potential, and there's a growing conviction, or at least discussion, that Bitcoin can serve as a hedge against inflation and provide portfolio diversification.
Yeah, you hear that argument a lot.
And market forecasts, like one from Bernstein, were suggesting a significant inflow, something like $330 billion into corporate Bitcoin treasuries by 2029.
That's a huge number.
It is. The emergence of Bitcoin ETFs has also played a role, definitely making Bitcoin more accessible and palatable to a wider range of investors.
Made it easier to buy.
Exactly. And back in May 2025, the general market sentiment surrounding Bitcoin was quite optimistic, with some analysts even projecting prices to reach $100,000 or higher. A lot of bullishness around.
So who else is operating in this space? What does the competitive landscape look like for Strive ST?
The competitive landscape consists of several types of players. First, you have companies like Strategy that directly hold substantial amounts of Bitcoin on their balance sheets. I think the source mentioned about 69 public companies holding over 720,000 BTC at the time.
So direct corporate holders.
Right. Then you have the Bitcoin ETFs, which offer passive exposure and are often more cost-effective and, frankly, easier for traditional investors to access.
Simpler for many people.
Definitely. And you also have publicly traded Bitcoin mining companies, which is another way to get exposure. What makes Strive stand out, or what they claim makes them stand out, is its aim to be an actively managed Bitcoin treasury.
That active management piece again.
Yes, seeking to outperform Bitcoin through sophisticated financial strategies and by advocating for broader corporate adoption. They're not just passive holders. They're trying to generate superior returns, or alpha, as they might say.
And what about the regulatory framework governing all of this? That seems like a big question mark.
It really is. The regulatory environment for cryptocurrencies in the U.S. is still, well, in flux and somewhat fragmented. You've got various agencies like the SEC, CFTC, the Treasury, all having a role to play.
Lots of cooks in the kitchen.
You could say that. There was anticipation around potential legislative clarity, maybe with the FIT21 Act, and hopes for a more innovation-friendly regulatory stance emerging in 2025. Stablecoin regulation was also a big topic.
Right.
A really significant development, though, was the FASB ASU 2023-08 accounting update.
Ah, yes, the accounting change. What did that do?
It mandates fair value accounting for Bitcoin. This means companies must report their Bitcoin holdings at their current market value on their balance sheets, with any changes in value impacting their net income directly.
So big swings in reported profit or loss based on Bitcoin's price.
Exactly. While this increases transparency, you see the current value, it also introduces way more volatility into reported earnings. Overall, the ongoing regulatory uncertainty remains a significant factor, a risk really, for companies like Strive and their innovative, maybe untested strategies.
It sounds like creating a company like this Strive as ASST isn't straightforward. What are the main obstacles for anyone looking to replicate this model?
Yeah, there are considerable barriers to entry. First, you need substantial capital to build a meaningful Bitcoin treasury. That's obvious.
Need money to buy Bitcoin.
Right. Then, navigating the complex and, as we said, evolving regulatory and legal landscape for digital assets and public companies requires deep expertise. It's tricky.
Legal and compliance headaches.
For sure. Securely managing large amounts of Bitcoin demands specialized technical and security knowledge. That's a whole different skill set.
Can't just leave it lying around.
Definitely not. Strive's model also relies heavily on sophisticated financial engineering, like those tax-free exchanges, the M&A for cash idea, using derivatives, which requires a pretty niche financial skill set.
Needs smart finance people.
You do. Gaining access to the public markets can be a lengthy and expensive process, too, which Strive cleverly bypassed through this reverse merger with AST.
Ah, the RTO shortcut.
Exactly. And finally, building brand credibility and investor trust is crucial, especially when you're dealing with the volatility of Bitcoin and employing these novel, maybe complex strategies. People need to trust you.
Makes sense. Let's shift our focus now to the individuals steering this new venture. Who's leading the Bitcoin-centric Strive?
Okay, the leadership team is primarily drawn from Strive Asset Management, with the former CEO of Asset Entities, the shell company, taking on a new role.
So mostly Strive people.
Mostly. Matt Cole serves as CEO and chairman. He brings significant experience from CalPERS, where he managed a substantial fixed income portfolio. I think you mentioned the 70 billion figure earlier.
Yeah.
And reportedly exceeded performance benchmarks there. He then led Strive Asset Management, overseeing considerable growth in their assets under management up to that $2 billion level.
Okay, so he's got financial management chops.
Seems so. Then there's Arshia Sarkani, who was previously CEO of Asset Entities.
Yeah.
He now holds the position of Chief Marketing Officer, likely leveraging his past experience for Bitcoin advocacy and education.
Interesting role change.
Yeah. Ben Pham and Logan Byrne, also from Strive Asset Management, are the CFO and Chief Legal Officer, respectively, and both serve on the board.
So the core C-suite is Strive.
Pretty much. And then there's Vivek Ramaswamy, co-founder of the privately held Strive Enterprises, Inc., which now holds that huge controlling stake in the public entity. He's a key influential figure, known for his anti-woke capitalism philosophy.
Right, that's Strive's original brand identity.
It is. Additionally, the source mentioned plans to appoint independent directors with specific expertise in Bitcoin names like Ben Workman, Jeff Walton, Evik Roy were mentioned. That could be a valuable addition, bringing in outside crypto knowledge.
Okay, what about their track record when things get challenging? Have these leaders navigated significant crises in the past?
Well, Strive Asset Management itself has faced public discussion, maybe some criticism, regarding its initial anti-ESG or anti-woke stance, and they reportedly moderated their messaging somewhat over time to broaden their appeal, which suggests maybe a degree of adaptability.
Softening the edges a bit.
Perhaps. Asset Entities, the company before the merger, faced NASDAQ non-compliance issues related to its stock price and stockholders' equity. But they did successfully regain compliance through cost-cutting and raising capital via ATM offerings. So they navigated that particular challenge.
Okay, they got back in line.
Right. The newly combined entity hasn't faced its own specific crises yet. Obviously, it's brand new. But its main challenges will likely revolve around managing Bitcoin's inherent volatility and the successful execution of their complex, possibly risky strategies. Strive's apparent willingness to adapt its messaging in the past could be an indicator of future resilience, but it's too early to say for sure.
How transparent are they being about their plans and how they operate? What are they telling the public?
Strive Asset Management has generally maintained a public profile, sharing their investment philosophy and broad strategies through their website, research reports, CEO interviews, things like that.
So they talk publicly.
They do. The merger announcement itself was accompanied by press releases and investor presentations, standard procedure. As a publicly traded company now, the merged entity will be subject to SEC reporting requirements, 10Ks, 10Qs.
The usual filings.
Right, which should provide investors with more detailed information about their financial performance and the risks they face. A critical aspect for investors, though, will be the level of detail they actually provide in these filings regarding their specific Bitcoin accumulation strategies.
Like how much are they buying, how, at what price?
Exactly. How much Bitcoin are they acquiring, through which methods, the 351 exchange, M&A, open market buys, at what cost basis, and what are the associated risks with each method. That level of granularity will be key for transparency.
So the crucial question then, based on what we know, do these leaders appear to be honest, competent, and genuinely focused on creating value for all shareholders, including the minority ones?
Well, Strive has been relatively upfront about their overarching strategy, their Bitcoin-centric vision. That's clear. CEO Matt Cole, as we discussed, has a demonstrated background in managing significant financial assets, so the competence in finance seems to be there. And their stated philosophy of shareholder primacy suggests a focus on investor returns.
But there's always a but.
There is. The highly dilutive terms of the merger for the original ASST shareholders, remember, they only got about 5.8% of the new company initially, and that ongoing legal investigation into the fairness of the deal. Those raise legitimate questions.
Fairness. Yeah.
Absolutely. While the stated goal is to increase Bitcoin holdings per share, which should theoretically benefit all shareholders if executed well and Bitcoin cooperates.
Big ifs.
Very big ifs. The initial ownership structure, with Strive Enterprises holding over 94%, gives them almost complete control. Whether their decisions will truly benefit the public minority shareholders or primarily the controlling entity remains a key uncertainty. It's something investors will definitely need to monitor very closely.
Okay, let's delve into their financial strategy. How do they plan to allocate capital in this new Bitcoin-focused entity? Where's the money going?
Their capital allocation strategy is almost entirely centered on one objective: accumulating Bitcoin, period.
Laser focus.
Pretty much. They intend to use all available mechanisms, including that potential $1 billion shelf registration we mentioned, to build a substantial Bitcoin war chest. This is driven by Strive's conviction in Bitcoin as a core treasury asset. Some commentary even suggested companies should adopt a Bitcoin-first approach.
So all roads lead to more Bitcoin.
Essentially, yes. Their M&A strategy, as we noted, isn't aimed at traditional business synergies. It's a tool to acquire cash at a discount from undervalued companies, which they will then deploy to purchase Bitcoin.
The cash for Bitcoin M&A still sounds weird.
It's unconventional share buybacks, not part of their plan. They clearly state they believe investing directly in Bitcoin offers superior returns compared to buying back their own stock.
Okay, no buybacks.
Yeah.
Dividends.
Extremely unlikely. They have no history, and their priority is clearly to reinvest all available capital into Bitcoin for growth. Dividends just don't fit that model.
Got it. So how do they measure success? Like return on invested capital.
Traditional ROIC is less relevant here. They'll likely use a more bespoke metric, probably focusing on the growth of Bitcoin holdings per share relative to the capital invested in acquiring it. The ultimate goal isn't just holding Bitcoin, remember, it's outperforming Bitcoin's own price appreciation on a per-share basis after accounting for costs and dilution.
So the fundamental question remains, can they effectively deploy capital to grow Bitcoin per share despite the anticipated dilution from their capital-raising activities? And can they do it better than just holding Bitcoin?
That's the multi-billion-dollar question, isn't it? Especially given the controlling influence of Strive Enterprises. Public shareholders need to watch that minimally dilutive claim very carefully.
Now let's move into the financial health of this new entity, or at least what we can assess at this early stage. What does the financial landscape look like for Strive AC?
Yeah, and it's crucial to remember that this reverse merger fundamentally resets the financial picture. The historical financials of AST, they're largely irrelevant now.
Start from scratch, basically.
Pretty much. We don't have comprehensive pro forma statements yet, so we need to focus on the implications of their new strategy and, importantly, the impact of that fair value accounting for Bitcoin we discussed.
Okay.
As of May 7th, 2025, AST's market capitalization was tiny, around $8.8 million. This is a really crucial point because it highlights the potential for massive dilution if they actually try to raise anywhere near that $1 billion shelf registration at these kinds of valuation levels.
Yeah, $1 billion is huge compared to an $8.8 million market cap.
Exactly. Traditional tries to earnings, PE ratios. Forget about it. They're no longer meaningful because the fair value accounting of Bitcoin will lead to incredibly volatile non-cash earnings directly tied to Bitcoin's price swings.
So PE is useless here. What do investors look at?
We'll likely see investors shift towards a net asset value, NAV-based valuation, focusing on the value of their Bitcoin holdings relative to their market capitalization. Are they trading at a premium or a discount to their Bitcoin assets?
Makes sense. What about revenue and profit?
The historical revenue growth trends from AST's old business are now secondary, almost meaningless. Future growth will be primarily measured by the growth in their Bitcoin holdings per share. Similarly, their historically weak profit margins are no longer the key indicator. Future profitability will depend almost entirely on the net increases in Bitcoin's fair value minus their operating expenses.
So profit equals Bitcoin price going up minus costs.
In a nutshell, yes. Very simplified, but that's the core driver.
What about their debt situation and their ability to generate cash?
Historically, AST had very little debt, almost none. However, this is expected to change significantly, dramatically even.
Because they plan to borrow.
Yes, Strive explicitly intends to use debt financing,
Right.
potentially through that big shelf registration, to fund their Bitcoin purchases. So we can anticipate a substantial increase in their debt-to-equity ratio, introducing significant financial leverage and the associated risks.
More debt, more risk.
Absolutely. Traditional free cash flow generation isn't really part of this business model either. Their focus is on raising capital debt and equity and deploying it into Bitcoin, rather than generating cash from ongoing operations like a normal company.
So cash in to buy assets, not cash out from selling things.
Right. Regarding valuation metrics, while the historical price-to-book ratio was around 3.0 post-merger, the key metric will be that price to NAV we talked about. Investors will be watching the premium or discount relative to the underlying value of their Bitcoin holdings very closely.
Okay.
So in the context of a Bitcoin treasury, profitability will be intrinsically linked to Bitcoin's price movements, highly volatile. And their balance sheet strength is speculative at this point. It's heavily dependent on their future Bitcoin holdings, how much debt they take on, and how much equity they can raise, likely diluting current shareholders. And it's worth remembering, the starting balance sheet of AST wasn't particularly strong to begin with.
And what about their longer-term financial stability? What can we infer there, looking out a few years?
Well, AST's historical earnings record shows a consistent pattern of losses. Looking forward, future earnings, as we've established, will be inherently volatile due to the significant price swings of Bitcoin. There's no escaping that.
Like volatility is baked in.
Completely. They have no history of paying dividends, and future dividends are extremely unlikely given their laser focus on reinvesting all available capital into Bitcoin. That seems certain.
So don't expect dividend checks.
Definitely not. Debt management will be absolutely critical. They're planning to take on substantial debt to finance their Bitcoin acquisitions, so effectively managing interest costs, dealing with refinancing risks down the line, and adhering to any debt covenants lenders impose will be crucial for their long-term stability.
A lot hinges on managing that debt well.
It does. Traditional working capital efficiency metrics, inventory turnover, days sales outstanding, they're less relevant in this context. The focus will be more on managing their overall liquidity. Do they have enough cash on hand for operational expenses, for servicing their debt, and importantly, for opportunistic Bitcoin purchases if the price dips?
Right. Need dry powder.
Exactly. So to summarize the stability outlook, their earnings will be highly volatile, guaranteed. And the potential for excessive debt is a significant future risk to monitor, especially considering the planned level of borrowing relative to their initial small equity base and the unpredictable nature of Bitcoin's price.
You mentioned the FASB accounting update earlier, ASU 2023-08. How will that specifically impact their financial reporting going forward? Can you break that down?
Sure. FASB ASU 2023-08, mandating fair value accounting for Bitcoin, will have a really significant impact on how their financials look.
How so?
Okay, first, their income statement will directly reflect the volatility of Bitcoin's price. Any unrealized gains or losses on their Bitcoin holdings, meaning changes in market value, even if they haven't sold, will flow directly through their net income each reporting period.
So huge paper gains one quarter, huge paper losses the next, potentially?
Exactly. It makes reported earnings very choppy and less indicative of underlying operational performance because there isn't much operational performance in the traditional sense.
Oh, okay, what else?
Second, their balance sheet will clearly show their Bitcoin holdings at their current market value. This provides a much greater level of transparency regarding this key asset compared to the old accounting rules where it was held at cost and impaired. So you see the real-time value roughly. You see the value as of the balance sheet date? Yes, much clearer. Third, they will also have enhanced disclosure requirements. They'll need to provide more detailed information in the notes to their financial statements about their Bitcoin holdings.
Like what kind of details?
Things like their cost basis for the Bitcoin, the fair value, and importantly, an activity roll forward showing how much they bought, sold, or received during the period.
Ah, okay, tracking the movement.
Right. So while this accounting change definitely increases transparency for investors, which is good, it also guarantees that their reported earnings will be subject to significant volatility driven purely by Bitcoin's price fluctuations, even if their underlying business activities, like managing the treasury, remain relatively stable day to day.
Got it. Transparency up, earnings stability down.
That's a good way to put it.
All right, let's pivot and look at how the market is interpreting all of this. What's the general market sentiment surrounding this stock, AST, after this big change?
Well, as of May 7th, 2025, remember, AST was a volatile microcap stock. It had a history of struggling to maintain NASDAQ compliance. So it wasn't exactly a blue chip.
Right, started small and shapy.
The merger with Strive represents such a radical transformation that market perception is likely to be, well, sharply divided, polarized.
Love it or hate it.
Pretty much. Some investors may see it as a groundbreaking opportunity, maybe the first mover in this specific niche within the digital asset space. Others will likely view it as extremely high risk and speculative, maybe even reckless.
Depends on your view of Bitcoin and the strategy.
Exactly. The ongoing legal investigation into the fairness of the merger could also negatively influence market sentiment, adding another layer of uncertainty.
That lawsuit cloud.
Right. And given the significant dilution for the original AST shareholders, we might observe some initial selling pressure from those holders who just won out after the deal.
Makes sense. Any signs of interest?
It's worth noting that trading volume was unusually high on May 7th, the day the merger was announced. That indicates significant market interest and activity. People were definitely paying attention and trading the news.
Are financial analysts offering their opinions on this? Are there any price targets available for the new Strive AST?
As of that date, May 7th, 2025, there were no specific analyst price targets publicly available for ASST.
None at all.
Nope. This is likely due to its previous status as a microcap company. They just don't get much analyst coverage, and also the transformative, almost unprecedented nature of this merger.
Too new, too weird for Wall Street analysts yet.
Kind of. Typically, analysts tend to cover larger companies with more established and predictable business models. This is neither. We might see some research coverage emerge in the future, perhaps from niche firms that specialize in digital assets or crypto.
Boutique research, maybe?
Possibly. But for the time being, investors will need to conduct their own thorough due diligence without much help from traditional analyst reports.
What kind of news coverage has this merger generated? What's the media saying?
The merger announcement on May 7th itself is definitely the primary news driver. That's the big story. Sentiment reported by news aggregators appears to be mixed.
Mixed how?
Some commentators were offering neutral perspectives, acknowledging the innovative nature of the move, but also highlighting the potential risks: dilution, Bitcoin volatility, execution risk, standard cautious approach.
Balanced view?
Others presented a more positive initial reaction in their aggregated news coverage, perhaps focusing on the first mover aspect or the bullish Bitcoin outlook at the time. Pre-merger news primarily focused on AST regaining NASDAQ compliance, which was positive, but now seems like ancient history.
Right. That's old news now.
And that ongoing investigation into the fairness of the merger is also a significant recent development that could contribute to negative sentiment in the press or investor forums.
So a mix of excitement, caution, and legal questions.
That sums it up well.
Okay.
Again, that substantial increase in trading volume on the day of the merger announcement clearly indicates that the market, and likely the media, are paying close attention.
What about the activity of short sellers and options traders? Are they betting against this stock or hedging? Is that even possible?
Okay, short interest. The data showed that short interest in ASST had actually decreased in the period leading up to the merger announcement.
So fewer people betting against it right before the deal.
It seems so, although the source noted some inconsistencies in the reported figures from different data providers. Always tricky with short data. It's also probable that these figures will change significantly following the merger as the market digests the new entity and strategy.
Makes sense. What about options?
Interestingly, the source stated that ASE is not optionable.
Meaning no options contracts.
Correct. No listed put or call options available for trading. This limits the ability of investors to hedge their positions using options or to speculate on the stock's price movements using derivatives. It removes one tool from the trader's toolbox.
So you can only buy or short the stock itself.
Basically, yes. No options plays available.
Now, let's examine who actually owns this company following the merger. What does the ownership structure look like? This seems really important given the merger terms.
It's incredibly important, yes.
Yeah.
The ownership structure has undergone a massive transformation. Prior to the merger, institutional ownership in AST was absolutely minimal, like fractions of a percent, mostly index funds or trading firms.
Basically zero significant institutions.
Right. Now, the primary institutional owner is Strive Enterprises, Inc., the private entity co-founded by Ramaswamy. They hold approximately 94.2% of the outstanding shares immediately post-merger.
Wow, 94.2%. That's almost everything.
It's overwhelming control. Legacy AST shareholders, the original public owners, are left with a significantly smaller stake of roughly 5.8%. And remember, this is before considering any further dilution that may result from the planned capital raises via that $1 billion shelf.
So their slice could get even smaller.
Much smaller, potentially.
Yeah.
This results in a very, very highly concentrated ownership structure.
And what about the insiders, the management team, and board members? What's their personal stake in this new venture?
Well, in the 12 months leading up to May 2025, the data showed there was net insider buying of AST shares, which is usually seen as a positive sign, though the amounts might have been small.
Okay, they were buying before the deal.
Some were. As of May 6, 2025, right before the merger closed, insiders collectively owned around 16.26% of the old ASST. Post-merger, however, the most significant insider by far is the controlling entity, Strive Enterprises.
Right, the 94% owner.
Exactly. The key members of the management team from Strive Coal, Pham, Byrne, Sarkani will also be considered insiders and will serve on the board of directors. Their future transactions in the company's stock, buying or selling, will be important signals for investors to monitor in SEC filings.
With such a high concentration of ownership, what are the implications for how the company is governed and run? Who's really in charge?
Well, there's no question who's in charge. With Strive Enterprises holding such a dominant majority stake, they effectively have near total control over everything. The company's strategic direction, the appointment of management, all major corporate decisions, board composition, everything.
So minority shareholders have very little say.
Practically none in terms of voting power. While Strive has publicly stated a philosophy of shareholder primacy, the critical challenge here will be ensuring that the interests of the public minority shareholders, that 5.8% group potentially shrinking, are adequately represented and protected.
How can they ensure that?
It really comes down to transparency in their corporate governance practices and decision-making processes. Clear communication. Independent board members could help if they are truly independent and empowered. But ultimately, with this level of control, minority shareholders are relying heavily on the controlling shareholder acting equitably.
And that legal investigation doesn't help build confidence there.
No, the concerns raised by the Halperseta investigation about the fairness of the merger itself certainly highlight the potential risks for minority shareholders in this kind of concentrated ownership structure.
Okay, let's try to synthesize all of this information now and conduct a risk assessment. Can we outline the key strengths, weaknesses, opportunities, and threats? A SWOT analysis for this newly formed Strive S's.
Absolutely. Let's start with their strengths. What are they bringing to the table?
Okay, strengths.
First, they have immediate access to public capital markets through ASST's existing NASDAQ listing, and that planned $1 billion shelf registration. That's a big advantage over starting from scratch.
Public access, check.
Second, they are proposing these innovative, potentially advantageous Bitcoin accumulation strategies, the Section 351 tax-free exchange, the M&A for cash approach. These are unique, if unproven.
Novel strategies.
Third, they have experienced leadership in complex financial management, particularly CEO Matt Cole with his CalPERS background.
Financial expertise.
Fourth, they can potentially leverage the existing infrastructure and brand recognition, whatever it may be, of Strive Asset Management.
Existing platform.
Fifth, they've established a platform for advocating for Bitcoin adoption among corporations, which should create tailwinds. And finally, they have positioned themselves as a first mover in this specific niche, the publicly traded, actively managed Bitcoin treasury.
Okay, those are the positives. Now, what about their weaknesses? Where are the vulnerabilities?
All right, weaknesses. Top the list. There is a significant risk of substantial dilution for both existing and future public shareholders due to their stated plans for raising huge amounts of capital relative to their current size.
Dilution risk number one.
Absolutely. Second, the ownership structure is extremely concentrated, with Strive Enterprises holding the vast majority of the shares, limiting minority influence.
Concentration of control.
Third, their novel strategies, the 351 exchange, M&A for cash, are complex and carry considerable execution risks. Will they actually work as planned?
Execution risk.
Fourth, they are fundamentally and overwhelmingly dependent on the volatile price of Bitcoin. If Bitcoin crashes, their whole model suffers badly.
Bitcoin price dependence.
Fifth, they have a limited operating history with this specific Bitcoin treasury business model. It's new territory for them, too.
Lack of track record.
Sixth, Strive's brand perception, particularly its historical anti-ESG stance, could be a weakness for attracting certain segments of investors or partners.
Brand perception issues.
And finally, there may be minor integration challenges or costs associated with the remnants of the pre-merger asset entities business, though that seems secondary.
Okay, quite a few weaknesses. Now, what are the potential opportunities for Strive AST? Where could things go right?
Opportunities. First, they can definitely capitalize on the increasing trend of institutional and corporate adoption of Bitcoin as a treasury asset. They're riding that wave.
Ride the adoption trend.
Second, there is potential for significant value appreciation if the price of Bitcoin increases substantially, especially if their active management strategies actually manage to outperform the market.
Bitcoin price upside, potentially amplified.
Third, that Section 351 exchange, if successful and approved, has the potential to attract a substantial amount of Bitcoin onto their balance sheet relatively quickly and tax efficiently for contributors.
Successful 351 exchange.
Fourth, they could potentially exploit market inefficiencies through their unique M&A for cash strategy if they can find the right targets and execute well.
M&A arbitrage, maybe.
Fifth, any favorable shifts in the regulatory landscape for cryptocurrencies, more clarity, lighter touch, could significantly benefit their operations and reduce uncertainty.
Favorable regulation.
Sixth, increased investor demand for Bitcoin-related equities in general could lead to a higher valuation multiple for their stock, a sort of scarcity premium.
Growing investor interest.
And finally, their advocacy efforts for corporate Bitcoin adoption could create a positive feedback loop, potentially boosting Bitcoin's price and benefiting their own holdings and market position.
Create their own tailwind.
Okay.
And finally, what are the key threats they face? What could derail this?
Threats. Number one, without a doubt, is the extreme price volatility of Bitcoin. A major crash is an existential threat to this model.
Bitcoin volatility risk.
Second, the ongoing regulatory and tax uncertainties surrounding cryptocurrencies and their novel strategies represent significant risks. A negative ruling or new restrictive laws could be very damaging.
Regulatory tax risk.
Third, they face competition, not just from direct Bitcoin investments and Bitcoin ETFs, which are often simpler and cheaper, but also from other companies that directly hold Bitcoin on their balance sheets, like Strategy. Fourth, there are inherent execution and operational risks associated with their complex financial strategies. Things can go wrong in implementation.
Execution failure.
Fifth, rising interest rates could increase their borrowing costs, especially given their plan to use leverage, and negatively impacted their financial performance.
Interest rate risk.
Sixth, negative shifts in overall market sentiment towards cryptocurrencies or risk assets in general could significantly hurt their stock price and business prospects, regardless of their own performance.
Market sentiment risk.
Seventh, the ever-present security risks associated with holding large amounts of Bitcoin hacking, theft, are a critical threat they need to manage flawlessly.
Security risk.
And, as we'll touch on briefly, potential indirect negative consequences from things like U.S. tariffs.
Okay, that's a comprehensive SWOT. Let's briefly touch on that last point you made. How might U.S. tariffs imposed in 2025 indirectly affect Strive ASST? It's not like they import Bitcoin.
Right, Bitcoin itself isn't directly subject to tariffs, but U.S. tariff policies, especially broad ones implemented in 2025, could have several indirect repercussions for a company like Strive ST.
How so?
Well, first, tariffs tend to increase overall market volatility and can contribute to a general risk-off sentiment among investors. When investors get scared, they often sell speculative assets first, and Bitcoin and related stocks like AST could fall into that category.
So tariffs spook markets, markets dump risk assets like AST.
That's one potential channel. Second, tariffs can also contribute to inflationary pressures within the U.S. If inflation rises, the Federal Reserve might respond by raising interest rates or keeping them higher for longer.
And higher rates mean?
Higher borrowing costs for Strive ST, which plans to use debt to buy Bitcoin. That makes their leverage strategy more expensive and riskier.
Okay, that makes sense. Any counter-arguments?
Conversely, some argue that periods of economic uncertainty or trade tensions could actually bolster Bitcoin's appeal as a non-sovereign hedge, a sort of digital gold. People like Michael Saylor have made this argument. If trade wars escalate, maybe some capital flows into Bitcoin, seeking safety, pushing the price up.
The digital gold thesis.
Exactly. There could also be indirect effects on the economics of Bitcoin mining due to tariffs on imported mining equipment, like servers and chips. This wouldn't hit ASST directly since they aren't miners, but it affects the broader ecosystem.
Right, ripple effects.
Also, a significant slowdown in global economic growth resulting from broad trade disputes could dampen overall liquidity and demand for risk assets, including Bitcoin. Less money flowing around generally isn't good for speculative investments.
Okay, so mostly indirect effects.
Primarily indirect, yes. Channeled to broader market sentiment, macroeconomic responses like interest rates, and ultimately, Bitcoin's price. Short-term, tariffs probably add to volatility. Long-term, the narrative of Bitcoin as a hedge could offer some benefit in a chaotic world, but that's debatable. However, the risk of increased capital costs for Strive AC's ambitious leverage-dependent strategy due to higher rates is definitely something tangible to consider.
So to wrap up this deep dive then, what are the essential takeaways about the newly formed Strive AC? What should listeners remember?
I think the key things are the transformation of AST into Strive's public Bitcoin treasury is a radical, almost experimental, and highly speculative undertaking.
Speculative is the key word.
Definitely. It's characterized by unconventional, complex strategies like the 351 exchange and M&A for cash. It has a highly concentrated ownership structure giving Strive Enterprises near total control. And its success is fundamentally reliant on the price performance of Bitcoin, plus their ability to execute those complex strategies and manage leverage effectively.
So high risk, high potential reward maybe.
Potentially. But the risks are substantial. It's a venture that carries significant operational, financial, market, and regulatory risks. It's likely suitable only for investors with a very high risk tolerance and a strong understanding of both Bitcoin and complex financial instruments.
Not for the faint of heart.
Not at all. From a traditional value investing perspective, there are certainly red flags: the dilution, the lack of earnings history, the dependence on a volatile asset, the governance questions. But the core question, if you were to invest, ultimately hinges on the management team's ability, specifically Matt Cole's perhaps, to effectively allocate capital and actually grow the company's Bitcoin holdings on a per-share basis, and ideally outperform Bitcoin itself over time.
Can they be smarter than the market and manage the risks? That's the bet.
That is essentially the bet, yes.
That paints a compelling, if complex and risky, picture. Now, for our final provocative thought to leave you with, given the overwhelming ownership stake held by Strive Enterprises, that 94% plus, is this truly a public company in the traditional spirit, accessible and accountable to public shareholders? Or is it more akin to a privately controlled Bitcoin experiment being conducted under the guise, or maybe the convenience, of a public ticker? Something to think about. If you found this in-depth analysis insightful and want to explore more complex financial topics, maybe some less speculative ones too, be sure to subscribe to the Stock Analytics AI YouTube channel. We dive into company analyses like this regularly.
And finally, a standard disclaimer. This analysis is based on the information that was available as of May 7th, 2025, and it should absolutely not be considered financial advice. Investing involves risk, especially in assets like this. Please remember that AI played a role in the research and preparation of this content. All the sources discussed in this deep dive, including that ASST Deep Value Analysis document, can be found listed in the description.